Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me are Sonia Shenoy and Pavitra Pari. Good morning, girls. Again, not bad, right? We opened below that 18,000 mark on the Nifty. 17,970 was the opening tick on the Nifty. So from that level, there has been a recovery of 120 points on the Nifty. We are flatlining, which when you compare with the rest of the Asian markets is a significant outperformance. Hang Seng is down 2.5%. The Straits Times is down 1.25%. The Korean markets are down close to about 1%. So the Indian markets continue with their outperformance. In that, it's the mid-cap and the broader markets which is seeing increased traction. So week to date, the mid-cap index is up 2.5%, while the Nifty is gained close to about 1.7%. The sector which is struggling today is the IT pack. The Nifty IT index is roughly down about 0.7% as we speak. Two-part reason. One, following the big 3.5% cut that we had on NASDAQ overnight. And two, as Cognizant, a large IT company which is headquartered, which is listed on the NASDAQ, but it's an Indian origin company, they have lowered their revenue guidance yet again. At the start of the year, Cognizant was looking at a 9 to 11% constant currency growth. They lowered it in the prior quarter. They further brought it down to a 7% growth. A lot of company-specific issues, but that on the sidelines is also weighing on Cognizant and the rest of the IT pack today.
Oh,
Hi.
absolutely. Hi. So IT is definitely under pressure, but what's doing well today is the banks, right? Because all of those are faring quite well. So some of the larger ones will come up for you, the likes of Axis, Indices. These are the ones which are holding up in the green. Some of the smaller banks, take a look at what's going on Karnataka Bank for the second day after the kind of big up move that we saw yesterday. You have that one doing well. PNB, IDFC First. These are some of the banks which are holding up very well. On the downside, in addition to IT, you have some of the auto names which are there. So the likes of Tata Motors, M&M, Reliance also, by the way, is seeing some pressure. But Sonia, now with this big queue out of the way, I guess next we'll focus on the US non-farm payrolls.
Oh, absolutely. And that's a point that one of the experts was also making, that now the poison is out of the system, right? People know. They know that there's another rate hike perhaps coming. They know that the Fed is hawkish. So I guess the Indian markets has digested that and sort of moved on. A lot of things to track. There's a non-farm payroll data. There's a slew of earnings that come out starting today in our own markets. There's SBI on Saturday as well. But you know what? Did you know that the Japanese market is shut today for Culture Day? And
wow.
yeah, it's a holiday there, Culture Day, to appreciate art, to appreciate culture. There'll be a time when Indian markets will also do that, right?
I have that.
just something to point out. But for our own markets, I mean, things have looked very good. If someone would have told you that the Fed would have gone and raised rates by 75 basis points and stayed hawkish and you'd had a flat outcome today, bulls would have taken it with both hands. So let's tell you what's lined up on the show in the next 1 hour. The indices are flat after tracking global cues as hawkish Fed commentary battered US stocks. Mid-caps outperform, banks gained, IT and consumer durables slide. We'll discuss the way forward with market expert Neil Bahal, who is the co-founder and CEO of Negen Capital PMS.
From the earnings corner, we will be joined by the managements of JK Paper, CMS Info Systems and Mahindra Holidays to discuss the quarter gone by and the outlook going forward.
M&M Finance and Varun Beverages surge in trade on the back of their quarterly numbers. Key management commentary coming up in just a bit.
And finally, in big earnings to track for the day, we'll get you expectations from Hero MotoCorp as well as HDFC. So all of this and lots more lined up for you over the next 60 minutes.
Okay, before anything, let us invite the first corporate on Trading Hour today, JK Paper. And now the reason why I want to talk about this stock is because if you pull up the chart, right, JK Paper, today the stock is up about 0.5%. Just pull up a 1-year chart of JK Paper and you'll realize why we've invited the management. It has had a phenomenal dream run, this chart. I mean, in the last 12 months, it's almost doubled. And it's reported its highest ever quarterly turnover. So very strong second quarter. Let's get the management on board. We have with us A.S. Mehta, who's the president and director of JK Paper. Mr. Mehta, good morning and welcome to the show. There's a new packaging board capacity that you have put on board, and that has actually aided your volumes this time. But post-COVID, it's been a big comeback for companies like yours, purely because perhaps demand is back. Just tell us a little bit about what the second half of the year could look like. In the first half, you've almost doubled your revenues and you're sitting on a base of 3,100 crores. Can you do the same in the second half?
Good morning. Thank you very much. In fact, this quarter has been a good quarter. I must say that all across all the product categories, the demand has been good because after the pandemic, everything has opened and is more or less the normal now, except some offices and other things. All the educational institutions and everything is back to normal. So the writing, printing paper, office paper, they are back to normal. I would say that we are better than the other players. And in fact, our copier market share has gone up from 23-24% to almost 28%. So this has been a phenomenal period for us for the office paper. As far as the packaging board is concerned, you're right. Our new machine, which we started sometime in January 22, we have already crossed 90% capacity of that machine. So I mean, the ramp up has been pretty fast, and the market has also supported. So the volume has come from one is packaging board and also the Sirpur paper mill, because this quarter the Sirpur has nearly almost 90% of the capacity. So that additional volume has come from Sirpur as well. So overall volume, if you think in this quarter, our volume is higher by close to 35%, 34-35%. And also the market has given a better price in view of the global paper and pulp prices. So this is about the quarter. And going forward, I would say that the office paper and the packaging paper, the demand is going to be strong. So I have no doubt about the demand for the office paper as well as the packaging paper. So put together, that constitutes something around 80-85% of our total turnover. Rest is some writing, printing, and also the coated paper. So let's see what kind of a demand comes up from the education sector. But otherwise, I would say that the second half is likely to be more or less what we have seen in the first half.
So just a follow-up here, because I think the last time you had mentioned that you'll cross 5,000 crore revenues by the end of FY23. But in the first half, you've already done more than half, I mean, at 3,100 crores. You think you can do better than the 5,000 crores that you guided for? And if yes, how much better?
Certainly, I would say that when I said 5,000 crossing, that time the prices were lower, and also we didn't expect this kind of a faster ramp up. In view of the first half of 3,100 crore net sales, certainly we should be closer to 5,500 to 6,000 crore.
So FY23 revenues seen between 5,500 to 6,000 crore rupees. Morning, sir. Could you tell us what the price of the paper is? Because we understand, on account of the Russia-Ukraine war, prices have gone up significantly. What does it currently stand at? And if you could break up that top line growth, 74%. I think you said 35% was an account of volume. Can we assume the balance 37% is, or close to 40% is an account of higher realizations, and will it sustain?
First, the breakup of 72%, you're right. 34-35% is the volume, and rest 37% is the NSR and also the mix, because the product basket has changed. Now the packaging board is close to 35% of our turnover, which was earlier something around 20-22%. So that has also, made some impact. So this is the breakup. Price-wise, I would say that Russia-Ukraine war has caused the higher energy prices and also the higher pulp cost and higher pulp prices. So that has impacted the overall global paper prices. But I would say that global paper prices are predominantly also a factor of demand and supply scenario, and also the input cost increases across the board. So our NSR increase has been across all the product categories, but now I would say that some product categories, the prices may not be sustainable, like the coated paper. The prices have already started coming down, and but office paper, writing, printing paper, the prices are going to be stable.
All right. Hi, Mr. Mehta. Can you tell us how much of a moderation you're expecting in the paper prices for the segments that you mentioned?
See, the coated paper prices, I would say that something around 7 to 10% the drop in the NSR is likely.
Okay.
Okay.
And can you tell us then how much of an impact are you expecting on the basis of this? Just expecting 7 to 10% on this segment?
See, this segment is a smaller segment as far as we are concerned. It is something around 7-8% of the total volume of the company. So I don't foresee any major financial impact as far as we are concerned of this particular segment.
So the moderation in prices is just in this segment you're saying, and the rest of it you think prices will sustain?
Yes, rest of the product category, I would think that it should sustain at least for a quarter, and thereafter it will certainly depend on the global pulp and paper prices.
Any margin guidance, sir? Sorry. Any margin guidance for FY23?
So I would say that the margin guidance, as I said about the prices, and also the margin for the first half. So I would not comment on the margin, the guidance for the coming quarters, because this has not been our philosophy to tell you the forward-looking margin guidance.
Sure. I guess, the reason we're asking is because there is a huge untapped opportunity because of paper replacing plastic, right? I mean, there's a substantial increase in demand for paper bags as well. And India consumes 6 billion plastic straws. And now a lot of companies are now moving to sort of paper straws. Can you tell us a little bit about that? Is it just theoretical, or is it actually happening? I mean, are you seeing more orders because of this replacement demand? And what could the addressable opportunity be for you?
No, it's not theoretical. I must say that it is happening, because when you talk about the plastic being replaced by paper, particularly you talked about the paper straw. In fact, the demand of paper straw paper has been phenomenal. In fact, we used to sell something around 20-25 tons a month, and right now we are selling something around 200 tons a month. So it is almost 10 times of what we used to do. And the paper containers, paper glasses, paper cups, and the sale is phenomenal. I mean, it is doubling, I must say. So the this is the reality. And in fact, the plastic replacement, it is happening, and there may be many more applications, like you said about paper bags. In fact, we used to do something around 100 tons a month of paper bags, and today we have a demand of 5-6 times of what we used to do earlier. So this is reality.
Okay.
All right, we'll leave it at that. Thank you very much for joining in. That's JK Paper, robust Q2, and the company is optimistic about the second half as well.
That's great, to hear. I mean, on a larger scale, when you look at it from an environment point of view, right?
Yeah.
The one thing that I really want replaced is plastic bubble wrap. When you order stuff, there's so much bubble wrap that comes in plastic.
Yeah.
If they can replace it with paper, I mean, that'll be a great thing.
But I guess then it doesn't serve the purpose of making sure that it doesn't get, the product that you're ordering
but
continues to be
speaking of the
fragile.
paper companies, you're talking about the dream run seen in this stock. Pretty much all of the paper stocks have done really well, right? So if you look at a Seshasai paper, that one is up 85%. Something like a West Coast paper is up 140% in the year. So that is the kind of move that we have seen on the paper stocks. But with that, we're going to get into our first short break on the show. When we come back, we should focus to the world of commodities. Manisha Gupta will join us to fill us in. Welcome back. You're still tuned into Trading Hour. The market is in the green now. 18,095 is what we have on the Nifty. So we've moved into positive territory. The banks are where a lot of the strength is coming through today. And that one is up 0.7% on the Nifty bank. But let's shift focus and talk about the commodity space now. Manisha Gupta joins us. And today she's looking at the crude prices. Manisha.
Well, thank you for that, Pavitra. Well, yes, we have seen resilience come in for the crude oil prices. It has been quite choppy in the last 24 hours, but as you can see, even after a 75 basis point rate hike, which was well factored in, and the expectation that you could be looking at higher interest rates going forward, the prices continue to hold at around 3-week highs. So almost $96 per barrel for the Brent prices and very close to 90 for the WTI crude prices as well. The US Fed chair did say that ultimate level of rates will be higher than previously expected. Even with that, we've seen markets continue to hold firm. firm, not just for crude, but most of the energy as a sector and the metal space as well. It also is about the Bank of England monetary policy meeting today, and a 75 basis point rate hike is expected out of that too. That is what the markets will keep an eye on now. Apart from that, it is about the European Union embargo that comes in place on 5th of December on Russian oil, and that seems to be adding some premium to prices because of supply concerns there. And then it has been about Saudi Arabia sharing intelligence on possible attacks from Iran. So some geopolitical premium also working its way into the prices there. The fall in US crude inventories by 3.1 million is something that the markets were not factoring in. There was an expectation of an increase in inventories, but a decline in inventories has been supportive too. If you look at the OPEC and allies moves, they're also going to cut output by 2 million barrels per day in the month of November. But at this point in time, in the month of October as well, their production has been much lesser than their agreed quota of 26.6 million barrels per day. It is down, it is less by, or it is a shortfall of 1.36 million barrels per day there. It's only Algeria and UAE perhaps which are actually producing in excess to the agreed quota. Rest all the OPEC members are producing lower. The markets also are watching out for the winter demand, and ahead of that the expectation is that you are perhaps bracing for higher crude oil prices going forward.
Thank you very much for that. It's time now for another corporate conversation. CMS Info has reported a good set of Q2 earnings. Revenue is up 27% year-on-year. The company's reported margins of 28.5%, an improvement compared to the margins same time last year. To discuss the quarter gone by, we're now joined by Rajiv Kaul, the Executive Vice Chairman, whole-time Director and CEO of the company. Mr. Kaul, morning. This is Rima here. Smart improvement in your margins. What led to it? And do you think there is scope to expand margins from the current levels of 28.5%?
So just for your viewers, we listed the company on December 31st, 2021. So we've been listed for about 10 months. As a company, we are on a transformation journey from being primarily a cash logistics platform in 2015 and trying to build a business services platform. I think we are doing well on that journey. We have now cash management as 65% of our revenue. Our managed services business is scaled up very well. And I think what the story and both the growth in revenues and margins is really a testimony to the fact that we are looking at vertically and horizontally expanding our business, and that journey is going on very well right now.
Okay, and the outlook on margins, sir?
So, we don't have a margin guidance. I think what we have given since we're listed is that we have an FY25 revenue guidance, which is to double our revenue from our FY21 base. Our FY21 revenue was 1,300 crores. Our FY25 revenue target is roughly about 2,600 crores, which is we are aiming at an 18% CAGR in revenue growth over these 4 years. As of now, we are tracking a little ahead of these numbers.
Okay. Just going by your presentation, you are at the moment the largest cash management company in India. We do know that. And you have about 150,000 servicing business points. Just trying to understand what kind of addressable size do you see in terms of an opportunity? How much can you grow your, servicing business points, your distribution, and what would that mean for your growth going ahead? Because you spoke about your revenue potential, but even in terms of margins, right? I mean, it stood at about 25% for FY22. Is this something that you can maintain?
So, if you look at our margins, our margin profile is best in class globally in our sectors in which companies we compete with. I also like to explain that this is almost in line with how you see IT services companies, large ones in India. And that's the whole goal of our company and the business is to build a platform with a strong margin profile, doing high quality end-to-end outsourcing contracts. We primarily work with banks and also in the retail and e-commerce sector. From your question on the business points, if I look at the addressable market, which we are focused on today, and I'm not talking about our expansion in the future, across both the ATMs and organized retail, we think that addressable market is almost close to 1 million as of today, right? A lot of it has still not yet been outsourced by the banks and in the retail sector. I think, so we feel that our business points, 115,000, have still a long way to go over the coming decade. The other metric which we track, which I think is also more relevant for your viewers, is the number of activities we do. So when you think of a logistics platform, which is our cash logistics business, and you try and compare it to other logistics companies you'll track, it's relevant to look at how many activities, akin to how many shipments you're doing, let's say. And that activity is growing very well. In Q2 of this year, we did 4.7 million activities, so roughly 47 lakhs, which has grown 6% Q-on-Q and about 11-12% year-on-year. So we're seeing a lot of resilience in cash usage in urban India, especially in the last 6 to 9 months. We are seeing as mobility, as people are again back to movement, going to offices, and commerce has picked up, we are seeing urban cash growth almost on a 23% year-on-year.
All right, got that. Hi, Mr. Kaul. Thanks for joining us. This is Pavitra. So you spoke about your cash management being around 65%. Can you also take us through what do you think is the growth potential for the ATM business, and how much do you expect that to grow and contribute? Also, this 65%, do you think this mix is likely to stay the same, or are you looking to increase the cash management?
So I'll start from the last question. Yeah. So our mix was roughly 100-0 5 years ago, 6 years ago. It's moved to 65-35 as of this quarter. Our goal was to hit 65-35 by the end of FY23. And our FY25 goal is to have 60% of our revenue from cash management and roughly 40% from our managed services platform. As of now, again, I think basis the order book, again, I think I should talk about our order book. We have a very healthy order book. It has expanded by almost 600 crores in first half of the year. We have almost 2,800 crores of order book on hand to execute right now. And that gives us a very good visibility and predictability when we think of our FY25 numbers and metrics. In terms of the ATM market and the retail market, I think they are growing very well. For us, we would like to see how this entire year goes, because FY23 would be truly the first year in 3 years where we hope that this would be COVID-free, and therefore would become a good baseline to track on an annual basis to see how this can move forward. Because right now you'll see a little lumpiness, given last year in Q1 there was a pretty serious COVID impact. Q3 had Omicron impact in the economy, and therefore I think we will pause and wait till end of the fiscal year to be able to give you some directional path on what we think the growth opportunity is for the next 5 to 7 years.
So that's, of course, for the next 5 to 7 years. But just coming back, you said in your managed services business, which is 40% of your book right now, you spoke about your new order wins at 600 crores in the first half, and that's something that you put in your presentation as well. But I noticed that you're also conducting pilots with some new customers in both banking and the NBFC space in remote monitoring. What kind of potential do you see here, and what's the visibility in terms of order book? Can you do this same 600 crore run rate in the second half as well in your managed services business?
Excellent question. I think we incubated a new business in AIoT, which is an IoT business with machine learning around remote monitoring 18 months ago. This business has seen very rapid growth. We've had a very good adoption of our technology amongst the banks. We started our focus primarily from the ATM base to automate the whole security infrastructure for that. We have right now gone live at 18,000 sites. This is one of the most rapid and faster growing IoT deployments in the country across any sector. This was 0 revenue last year, and we are hoping that this business will hit 100 crore annual run rate in this fiscal year itself. So I think that's one business in which we are now expanding the use cases from ATMs, going into bank branches, looking at vaults, looking at gold loan companies, looking at insurance companies and NBFCs to see if we can expand the deployment of our IoT business across sectors. Our first focus remains BFSI, because that's where we have the long-term relationships and we have a very good understanding of the customer needs. But over the midterm, we would look to expand across and make it a more horizontal play.
Just one final word. The cash management business in India as well as globally is increasingly becoming more consolidated. Scale promotes higher profitability. Could you tell us what your market share is? Would you look to make some acquisitions, increase your presence here?
So scale absolutely helps grow and maintain your margins and maybe grow the margins. But the caveat is that you would need to have a very robust technology infrastructure to do it, because cash management, I always have said this for the last 10 years, this is a risk management business. Therefore, you need to manage risk very well. It comes down to how much of technology, how smartly you're using technology to predict and prevent any issues out here. From a consolidation perspective, it's therefore an industry which globally has consolidated. India has seen its ups and downs. When we started the business 12, 13 years ago, there are 4 players. It quickly expanded to 8 or 9 companies, and now there are 4 to 5 companies in the sector. We think this should consolidate because it will be very difficult for people to manage this business as it grows in the country. Are we an ideal buyer for these companies? I think time will tell. I think we are, as a management team, very focused on pragmatic and value-oriented M&A. We have built up a very good market share profile. We have the network and reach. Therefore, buying a company for growth is not really something which we are quite excited about. We rather use our capital to expand into other sectors. But if there is something which is available at a good price, we of course will look at it.
Thanks a lot for joining in. That's CMS Info Systems. They've had a dream run. Actually, the stock has done really well, and the earnings have also looked pretty good. By the way, for the market, the buy on dips is working beautifully today. The Nifty is almost in the green now, and so is the Sensex. The mid-cap index is up over 100 points, and a lot of big movers. Federal Bank has once again hit a fresh high, so that's the stock of the moment, up 65% this year and up about 3% today. So we'll talk about all this and more on the other side of the break. When we come back, Himanshu Gupta of Globe Capital will be with us to give us some top trading bets. Stay tuned. Welcome back to Trading Hour. The stock of the moment is Alembic Pharma. So just pull up that name for you, 9% higher now. I mean, it's not seen top honors this year, to be honest. It's down almost 20% for the year, but today it's making a big comeback. That's because it's got a nod for a pain drug, a pain injection, which has a market size of almost $60 million. So for today, Alembic Pharma is one of the stocks of the moment. We'll get more on that in a bit. But in the meantime, a quick technical check from Himanshu Gupta of Globe Capital, who joins in. Himanshu, welcome to the show. It was a great day to buy the dip, and that's pretty much what's happened through the course of the day so far. But what do you see as the trend for the rest of the trading day, and what are the stocks that you'd look at?
Good morning, everyone, and thank you so much for having me here. Well, absolutely, it's heartening to see the kind of resilience Indian markets have been showing. I mean, the immediate area of support, 18,000, even that cannot be breached after a big volatile session on the Wall Street that we saw yesterday. And from that 18,000 lows, we have seen a very good recovery and, more importantly, a broad-based buying into the markets today. Second good observation here is that Nifty Bank and the financials, which have been dragging and kind of not participating so far in the markets, have actually led from the front today and actually managed to outperform after a short breather of past few days. So I think the setup is quite good, and I think the best is to buy dip on this market. If you talk about the ranges and the levels on Nifty, I think 18,000 remains the first very good area of support. That's a very short-term view. And as long as we are above that level, nothing to worry about. Just buy the dips towards that level. Keep a stop loss below 17,950. On the upside, I think 18,200 followed by 18,350 are the two very short-term targets that we are working upon. But if you have to take a slightly bigger view, I think 17,800 should be a positional stop loss. And as long as we are holding above that level, I think it should be every dip should be used as a buying opportunity. Now, more importantly, a bigger strength is coming from the financials and the Nifty Bank, as I just pointed out. And I'll be very closely looking for a level of 41,500 on Nifty Bank to be taken out. And as soon as that's taken out, I would expect Nifty Bank to rally at least 2,000 points, and 43,500 are the immediate short-term targets I am working upon once a breakout above 41,500 is seen. So the trend looks positive, and I think maybe for the next few days, it's time to participate into the small caps and the mid caps, which have been laggard over past few weeks, and we might see buying coming in those sectors also.
We've already seen buying in the broader markets. Himanshu, morning. What about individual stocks?
Good morning. Well, on an individual side, I think State Bank of India is looking good. I think that stock is looking strong enough to test that 600, 610 mark in the near term. So SBI can be bought with a stop loss below 574, target 600, 605 from a 1 to 2 days perspective. Second one is a buy on Aditya Birla Capital. That stock is also showing a good strength, and I think on the verge of a very strong breakout on the technical charts. Derivative positioning is also looking strong to me. So AB Capital is a buyer on current levels, a stop loss below 116, and targets of 126 and 130 can be placed here. And finally, a cash segment stock, that's NLC, formerly known as Liveni Lignite. That stock, I think, is looking quite interesting to me. And on the long-term charts, it's on the verge of a very, very big breakout. Stock is trading close to 81.5 as of now. Would like to place a stop loss below 77 on a closing basis. On the upside, the first target to begin with would be 90 odd levels. And once the 90 is taken out, I think it will be soon enough that the stock will actually hit that 3-digit mark and move above 100 odd level. So NLC can be bought with a stop loss below 78.
All right, Himanshu, thanks a lot for joining us and taking us through your quick technical check on the market. But with that, we're going to get into a short break now. When we come back, the management of Mahindra Holidays will be joining us. We'll talk about their quarterly numbers and how Q3 is shaping up as well. Welcome back. You're still tuned into Trading Hour. We are in the thick of the earnings season. So let's talk about another corporate, that's Mahindra Holidays and Resorts. This is the one on our radar. The company saw a subdued performance and a mild dip in domestic margin in what has been a seasonally weak quarter for the entire hospitality industry. Weakness in its European business has also weighed on the performance. But to discuss all of the numbers as well as what the road ahead looks like, we're joined by the company's MD and CEO, Kavinder Singh, on the show. Mr. Singh, good morning and thanks a lot for joining us. This is Pavitra. Now, I know that this is, a seasonally weak quarter. So let me ask you about how Q3 is shaping up. Take us through what the occupancy is looking like, because in Q2, you were at around 79%. If I remember correctly, you had said that Q3 could be above 85. So are you on track to do that?
Yeah, just to sort of correct this, misunderstanding that, in Q2, we did not have good occupancy. 79% is on an expanded base of 500 rooms that we had added during the last year. Our occupied room nights have gone up by 27%. We had our income growth by about 34% on YOY basis, basically keeping the same quarter of the last year in mind. We have actually grown very significantly, and both our income, EBITDA and PBT levels of the standalone business are the highest ever that we have achieved in our history. And most importantly, our income also grew by about 14%. And if you exclude the one-offs that we had last year because of the income tax refund, interest on income tax refund, as well as some lease rent waivers we had, our income actually grew by 19%. And the best part is that our margins are at about 28% EBITDA margins and 14% PBT margins. And these are 500 basis points up on pre-pandemic levels, by about 500 basis points up for the EBITDA and about 280 basis points for PBT compared to the pre-pandemic levels. So all in all, this was a fantastic quarter for us, considering that typically it's a seasonally weak quarter. And yet we delivered fantastic numbers, as I just mentioned this to you.
Okay. Kavinder, now that things have opened up in a big way, I just want to understand whether there are new member additions, right? On an average for the last 2 years, despite COVID, despite the slowdown, you've been adding about 12,000 members annually. In the first half of the year, you did 8,200, so I'm sure you'll exceed that 12,000 number by the end of the year. But what's the guidance for perhaps FY24? On an average, what could it be?
So the best part for us has been that two questions, one question which was there in the previous one, which I will also answer. The October ended up with about 82.5% occupancy, and we are definitely looking to come closer to 84-85% occupancy. And this is going to be, again, seasonally. Of course, it's a good quarter. Again, it'll be the best quarter ever, at least as far as occupancy goes. And consequent impact on the resort incomes is also going to be seen. But coming back on the member additions, I think our member additions in this quarter were very robust at 4,400. And if you were to look at the running last quarters, we are already trending above 16,000 member additions in the running last 4 quarters. Obviously, this year we are going to cross the 12,000 number. We are noticing significant traction in the inquiries because people realize that vacation ownership in these times of inflation is a great deal, because when people pay up today, they don't have to pay for the 25 years or 15 years or 10 years of room rentals with us. And of course, they have to pay the annual fee, which is a small amount relative to the spiraling prices that you see in the leisure destinations. So all in all, we are very confident of growing our member base, which is standing at about 275,000 members. And as I mentioned, the last 4 quarters on a running basis are at about 16,000 run rate now.
Can you talk a bit about your European business, HCRO? How is it faring and when do you think it will turn into the black on an operational basis?
So it has already turned in black. If you were to look at the numbers of HCR, which are the Finnish accounting standard numbers, they turned in an EBITDA of about 1.9 million euros, despite the situation which you have mentioned about the Russia-Ukraine war. The occupancy was at about 70%, which is higher than any other hotel or the hotel chain. And the most important thing is that if you were to exclude the one-offs that they got last year, which were government subsidies due to COVID, their actually performance is brilliant, 14% growth in income and 23% growth in EBITDA. And also at EBIT level, they are positive at about 0.3 million euros. So they have been positive. They are looking at future also with a lot of positivity because the Finnish travelers, domestic travel continues to be very strong. Our Sweden business also delivered a great performance, which is a subsidiary of the Finland business. And the Canaries business also did extremely well during this quarter. As you know, it's seasonally strong quarter for them. And despite the war, we did not see any impact. Of course, the input costs have gone up, but yet they delivered in terms of numbers, a very impressive set of numbers that we saw in this quarter too.
So talking about input costs and inflation, when the membership comes up for renewal, would you look to up your pricing, and if yes, by how much?
So typically our membership would renew after a very long periods of time because these are long tenure memberships. And whenever somebody wants to renew its membership, it will be the existing prevailing prices. But just to give you a sense as to what kind of price increases we have been taking on an annual basis, last year in two different tranches, we added up about 7 to 8% in terms of the membership fee. And our annual fee, because it's inflation linked, went up by about 7%.
Okay, Mr. Singh, on the inventory addition, if you can just take us through the plan there. I think currently you're around 4,700. You have said by FY25 you're going to get to 5,500. Could you tell us how much you're looking at in, say, this year in FY23?
So you can see that we are tracking well on inventory. We are definitely likely to exceed 5,500 mark. We have already hit 4,715. We added about 100 odd rooms, 116 rooms. We added 3 resorts. And therefore, we remain very optimistic about growth in our inventory, which will lead to obviously member additions growing stronger, which will lead to very high resort incomes and the occupancies on an expanded inventory base. As I mentioned, we grew our occupied room nights by 27%. That would be another kicker that we will see as we move forward.
Okay, one final question very quickly. Will you look to demerge or separate your European vertical, your European arm?
At this moment of time, we are quite optimistic about the situation in Europe, despite the headwinds caused by the war, because the Finnish travel and the Swedish travel and people into Canaries are coming in because of the post-pandemic unlock. There is significant travel happening. Occupancies are good. So at this moment of time, we will remain focused on creating value, which is there is an inherent value. As you know, this business had delivered a 12 million euro EBITDA 2-3 years ago, and then came COVID, and then we have this war. But we are very confident of delivering much better numbers than last year in this quarter, as I mentioned, in this year. As you know that even in this quarter, we delivered 1.9 million euro EBITDA positive, which shows that the business has the strength and the brand equity to take the business to the next level.
Mr. Singh, we'll leave it at that. Thank you very much for joining in. That's Mahindra Holidays for you. Get into a break. Up next, we'll discuss the way forward. We'll also put the spotlight on Piramal Pharma. Neil Bahal, the founder and CEO of Negin Capital PMS, joins in next.
Welcome back. You're still tuned into Trading Hour, and let's focus on the market now, which, by the way, is back in the red a little bit after moving into the green. So we're currently around 40 points in the red. The mid-cap index is what is, holding up well. It is around 0.3% higher, and the Nifty Bank is also seeing a gain of around 0.4%. But let's talk about Piramal Pharma now, and we have a guest joining us who can take us through that conversation. Neil Bahal, founder and CEO at Negin Capital PMS, joins us on the show now. Neil, good morning. morning, and thanks a lot for joining us. This is Pavitra. So, let me just come directly to Piramal Pharma. We saw the demerger, we saw the listing. Take us through how you're looking at this stock now, after it being removed from the MSCI. How do you think the stock is likely to fare now? Because once again, it is doing well in trade.
Hi, Pavitra. Good morning. Just a disclaimer before I say anything that we own Piramal Pharma in our PMS. So this is not investment advice. It's just, I'll just tell you what has happened here. So Piramal just did a demerger, right, where they split their the NBFC and the pharma business. And whenever anybody used to buy Piramal, they would buy it largely for the pharma business because they have an excellent track record in pharma. They have been doing it since multiple years, and they have, they're very, very good at what they do. Now, what happened was they also had the real estate NBFC, and for certain years, the real estate cycle was negative. So whoever used to buy Piramal, they would largely take a call on the pharma business. But while valuing the pharma business, they also had to value the NBFC. So for whatever reason, the pharma business used to trade at a good discount to the peer group, let's say Syngene or DVs and so on. So it was already at a discount and it went for a demerger. So suddenly at a demerger, what happened was that the pharma business, the market capitalization reduced. And when it listed on its own, the market cap was lesser. So MSCI came and said, okay, you don't qualify to remain in our index anymore. And we got to delete you. So because of that, even more forced selling came from these passive funds. And the stock listed at 200. And now it's fallen down to 157 at the bottom. And I feel at this point of time, it's trading at a significant discount to the entire peer group. If you consider even something like a Suven Pharma, which is having a very, it's not at all comparable to Piramal in terms of how big the Piramal business is. Suven trades at a premium to Piramal. So I think in terms of what the MSCI has done, it's made this stock a little bit too cheap.
That point is taken, but that's in the past, right, Neil? I think the big question now is Piramal Pharma has a very differentiated business model, right? It's present in this whole CDMO space, contract development and manufacturing. 60% of its sales comes from there. What kind of growth do you see for this business particularly? And even in the other verticals, I mean, it has 30% sales from the complex hospital generics, 11% from India consumer products. So what is the growth and what's the fair value for the stock from here on?
Hi, Sonia. So what happens is that it's a very highly integrated CDMO business. So as you rightly said, 60% of the revenue comes from CDMO. And this is very, very integrated business. I think in India, this is the only properly integrated CDMO business. Even if you take Syngene, they don't have the manufacturing capability even now. They're going to have that in FY24, where Syngene also will become an integrated player. So Piramal is a big company. I think they have 125 plus integrated projects that they're working on. So I think this company for growth there'll be nothing fancy in terms of growth, 15% growth, which is very good for a company this size and operating in a very complex market. The growth will be 15% on the revenue, but as the management has guided, there will be a growth, there will be a jump in the margin every year for the next, let's say, 2 years, 3 years, 4 years, 5 years. So while the revenue may grow 15%, something like an EBITDA over here may grow at 25%, in our opinion.
Neil, do stay on. We need to get into a quick commercial break. We'll come back and continue this conversation. Welcome back in conversation with Neil Bahal on Piramal Pharma. Neil, you briefly spoke about how Piramal Pharma trades at attractive valuations versus its peers despite being larger in size. Could you elaborate a bit on that?
Yeah, so some of the comparable peers are like the most expensive is DVs, which trades at something like a forward multiple of 22x EV to EBITDA, followed by Syngene, which is around 20x. Followed by Gland, which has fallen off a cliff and come down to something like 17.5x valuation. And Suven trades at about 16x. Because of the MSCI forced selling, I think Piramal listed at 200 and then fell to 157. At that point, the valuation in Piramal had actually dipped to 9.5x FY25 earnings. So in my opinion, it trades at quite a big discount to its peer group.
Okay, all right. Thanks a lot, Neil, for joining in. Have a great day. That's on Piramal Pharma. But let's leave you with the Devyani International numbers looking rock solid there. Almost a 30% growth in the profits for Devyani International. People definitely going ham on the pizzas and the KFC for sure. I mean, just look at the top line growth as well, looking pretty good. But we'll do one thing. We will take a quick break on that note and come back with lots more on Halftime Report. Don't go anywhere.